Good afternoon, and welcome to the first quarter's capital market review. This report is a attempt to keep you focused on where we think we are with respect to the economy. Every capital market review, I come up with a theme, and I would have to say the first quarter's theme would be increasing volatility. As always, the reason we do this is because at the end of the day, the economy matters. And what we're going to try to do is dissect certain aspects of the economy. We'll talk about growth, job prospects, corporate profits, inflation, and we'll also talk about interest rates and where the Federal Reserve is, or at least where we think they are. Our purpose is to attempt to answer the questions, hey, where are we with respect to the economy? And more importantly, where do we think it's headed? To provide asset allocation or guidance with respect to portfolio management, essentially we have to get two things right. We need to have some idea of where we are in the economic cycle, and we also have to have some idea where the Fed is. Presently, and this has been the case for the better part of 6 months or so, I think we're in this kind of slow growth period here. We're certainly outside of the big robust recovery. I don't think we're in the aging or slowdown period yet. And if I were to handicap this, this is probably the 7th inning or so. So there's still a little bit of room for growth to come. In this period, interest rates start to rise. Generally, you see a heightened degree of volatility. You see moderate GDP growth, and certainly we've been anemic to moderate. And we also generally see double-digit gains for the stock market. This has eluded us so far. The other thing we need to get right is where the Fed is, because if they're in a policy where they're generally loosening and being accommodative versus constrictive and tightening, certain assets work differently than others. In all cases, whatever period we're in here with the economy, as well as wherever we think the Fed is here, will have an impact and favor certain assets and certain classes of securities and disfavor other assets and classes of securities. And finally, the reason for all of this is we want to make sure that we stay balanced, we stay diversified, and as always, we stay as invested as we possibly can. The 4 topics for this quarter will be, very quickly, a review of this past quarter. We'll talk a bit about world economics and what things look like off the U.S. shore. We'll talk about where the Fed is and hopefully what we think the Fed is thinking, and then also what opportunities still exist for us this stage in the economic cycle. So let's start with a quarter in review. Well, as you can see here, from market bottom, which is March of 2009, the stock market has had a stellar return. In the end of the first quarter, valuations kind of came back a bit from the lows in January and February, but we're still a bit below where we began the year, and certainly still a bit below where the high water mark was, which would have been probably August or so of 2015. A tremendous amount of volatility. This represents about a 15%, about a 13% drop, and this also represents about a 13% drop. If we look at where we are in terms of valuations, prices are at this point, PEs that is, are a bit above the long-term trend. At 16.6, that's certainly above the 15.8. Not problematic, but certainly not cheap. And if we look at other valuation metrics, the only thing that still looks relatively cheap is the earnings yield spread. And the earnings yield spread is actually 0.7% above bond yield. And that's generally pretty favorable for the stock market. For the last quarter, things were completely different than last year. What I mean by that is we look at 2015 as an example. We'll see that large cap tended to perform better than small cap, and growth tended to perform better than value. With the disturbance that we had this past year, first quarter, value really started to outperform growth, and the mid caps actually performed better than large cap. A lot of this had to do with the rebound in energy. Many of the energy stocks were considered value stocks at the time. While we had a very impressive 200+% move from the bottom, the international markets haven't had quite as much, only about an 80% move. And they've also suffered a pretty rough start to the year. As such, there seems to be a bit more value looking at international companies just because they haven't participated in the rally like the U.S. has. And we'll talk a bit more on this a bit later. Another thing we have to consider are interest rates. And as you can see, we've had an incredible drop in interest rates over the last 30 some years. Going into the end of last year, we had an uptick in interest rates in anticipation of rising rates. The Federal Reserve was expected to start raising rates. Then in February, Janet Yellen made some comments regarding negative interest rates here in the States, and interest rates plunged. In fact, through the end of March, they were at about 1.78%. In other words, a 10-year U.S. Treasury was priced to yield 1.78. As of the end of last year, that was about 2.2. And in fact, at one point during the second week in February, the yield was 1.5. So, all the things that we thought would work well in a rising interest rate environment, large cap, growth, investments that generally would do well in a rising interest rate environment, really haven't performed well, at least to this point. International has underperformed. The expectation is they would outperform. Growth has underperformed. And bonds that were very defensive, that would protect against rising rates, really didn't deliver any return. And long-term bonds, because of the drop here in yield, performed well. This is beginning to change. Let's talk a little bit about the world and world economies. You know, if you were to look at different asset classes and just look at this third column here, which is effectively different categories of investment, one thing you'll notice is the bond market was positive and the stock market, including dividend, was slightly positive. If you were Rip Van Winkle and slept during the whole quarter and then awoke at the end of the quarter to look at this, you would think everything was fairly copacetic. It was a very smooth quarter, not a lot of news or excitement. The reality was it was anything but calm. There was a tremendous amount of volatility, and a lot of it was miscue, misdirection from the Federal Reserve. We think our premise that the dollar will strengthen, that interest rates will rise, and that the market will improve as the economy looks better, we think that premise has not changed, and at some point the market will start to shift back into our favor. Let's look at the recovery. The recovery in the U.S. has been fairly long. This recovery that we've had since the Great Recession is now in its 81st month. Again, this is through the end of the first quarter. And when compared to other recessions going back to the 1900s, you'll see that there are very, very few that were as long as this recession here. So that data has a lot of people concerned. Others are saying, well, wait a minute. Let's also compare this recovery actually to the degree and strength of the recovery. While it's been 81 months, it hasn't been very strong. So when we start comparing other recoveries going back to 1948 and 53 and such, and looking at the strength as defined by real GDP growth, you'll see this recovery of 81 months has been one of the most anemic and weak recoveries we've had. That gives credence to those folks who say, look, because we've had such low, slow growth, there's a good chance that it may continue for some time to come, causing the recovery to be quite a bit longer than most expect. And that would counter the concern of, hey, we're getting long in the tooth, maybe a recession is right at hand. Let's also look at unemployment. The unemployment rate has come down significantly. We're at 5%, and we kind of started the recovery at about 10%. And we're beginning to see for the first time in a very long time some degree of positive wage growth. That's hugely positive. That really favors consumers. They have more discretionary income. If we look at the unemployment rate, it's below norm. If we look at effectively the wage growth, it's a bit subpar. That has a lot to do with the anemic nature of the recovery. If we look at the number of jobs gained since the recovery, we've at 14.4 million has certainly more than offset the nearly 9 million that was lost. But the issue and the concern is really wage force participation. And this comes into a print. It's discussed often, and folks are concerned with, yes, while we have a number of new jobs, these are a lot of underemployed jobs. And if you look at wage force participation, which is actually the population of employed workers looking for work as a percentage of total, you'll see that numbers come down significantly. And that causes some concern. This is a really interesting chart, though, because it breaks up wage force participation into a number of issues. Cyclical issues, which have more to do with seasonal effect. Retailers put on people as you go into the end of the year, they take people off. Other issues such as perhaps technology. Also other issues as in employability. Without having a discussion on social issues with respect to the U.S., if you look in some communities, the number of adult males that are seeking jobs without a criminal record, very small percentage. A lot of our young adults have some minor impossession or some record that might cause some problem with employability. But the big culprit here is age. Simply put, the baby boomers are starting to retire out, and we have less folks out there participating in the workforce. And that's a lot less of a problem than we've had in the past. And most of this is being offset by some degree of productivity. CPI is starting to kick up. Not problematically, but if we start looking from the standpoint of retirement, we need to make sure that we're positioned for growth. Not that we're getting growth these days, but that the portfolio is positioned for growth. We de-risk too much, we're going to run into some problems down the road. The 50-year average for inflation runs in the high 3s to low 4s. We've been spoiled the last couple of years with very low inflation, but that's starting to tick up. Headline inflation is beginning to tick up a bit, as is core CPI. To a large degree, both of those numbers would normally be higher than where they are right now. We saw that on the slide before because of the wage growth issue. But it's not, because in some part it's being offset by lower energy prices. But when energy prices start to normalize, and as of this recording, oil prices are higher than they were at the end of the quarter, we'll start to see the inflation numbers slowly creep up. Manufacturing is really improving globally. We're beginning to see an improvement in economic activity, not only here in the U.S., but elsewhere. This is referred to as a heat chart, and it talks about improvement in manufacturing as defined by the PMI numbers. Green is good, red is bad. Anything over 50 is green, which would indicate expansion. Anything below 50 starts to move toward red. And you can see, to a large degree, most countries now, compared to where they were just several months ago, are starting to move more in line with green. We're losing some of the reds, we're adding some yellows. Things are slowly beginning to improve. And that's very much true in Europe. And part of that is because of the stimulus that the European Central Bank is providing. If we look at the European recovery, it too is somewhat anemic. They're enjoying about a 10% unemployment rate, down from 12. But remember, their central bank just started last year some of the same stimulative packages that we started better than 4 years or so ago, quantitative easing and such. And because they've pushed interest rates into almost a negative interest rate environment, demand for loans are really starting to rise. And as a result, that will have positive economic activity. Japan, sadly, is another story. Their employment rate is only 3.3. They have almost full employment. They've had some degree of wage growth, but as far as economic activity, it has been abysmal and has been really slow for a very long period of time. In spite of that, their market since 2009 has enjoyed some pretty good returns, nearly doubling over that same period of time. So their market has performed better than Europe, but maybe less well than the US. China, which has been a huge concern, is also showing some signs of improvement, not to the point where we're excited about emerging markets or China presently, but we're beginning to see some improvement both in manufacturing and a little bit of an uptick as well in the service environment. Vehicle sales have been really poor compared to the peak several quarters ago, but you're beginning to see the Chinese government really start to use some more stimulus, and that should effectively stoke their economy. They have a few tools in place. So in terms of tools that China has available, one is they've been bleeding off a bit their huge amount of foreign reserves to help kind of stoke up their economy. They have the ability to play some games with respect to the reserve requirement. They could lower that somewhat, and that would help to foster some economic activity as well. As far as investment, and that would be government investment, that's this purple number here, you can see that last year in particular, they shrunk the amount of government involvement, and the growth has really come from consumers. That's by design. But if the economy gets too slow, the expectation is China will step back in a bit to help kind of guide this thing so that it doesn't, frankly, come off the rails. All right, so let's now focus our attention on where we think the Fed is and what we think the Fed's thinking. Let's start with oil. Obviously, in the first quarter of the year, we had a huge drop-off in oil, and that caused a big concern with respect to the Federal Reserve, and as a result, comments about negative interest rates. The real issue is this: demand for oil, both in the States as well as globally, will over time continue to grow. Consumption continues to move up. And as a result, this huge amount of inventory that we have here will eventually slowly get worked down. But what happens is we've had such a huge drop here in rig count that it's going to take quite a while to get some of those things re-engaged and moving back up as well. So there will be an equilibrium here that'll probably cause prices to start to move a bit higher. We don't expect a lot of movement over the next year or so, but we certainly think that at some point oil prices will be a fair amount higher than where they were. And presently, they're somewhat higher than where they were back in February. So we don't think that this is a period of long and low prices for a significant period of time. We think it's somewhat of a supply issue that has happened, especially because of the incredible amount of oil that's being pumped because of the Saudis and OPEC, that at some point will get reversed and slowed down, and things will then at some point become a bit more normalized. The US dollar has been strengthening, and while it fell back here a little bit this quarter, in part because of the talk about negative rates, we think effectively that will continue. The dollar, we think, continues to strengthen this year. What's happening right now is we're, to some degree, in a de facto currency trade war. Our dollar continues to increase, while the dollar in the Eurozone and Japan has been dropping, making their goods and services a little bit more competitive than the US. Interestingly enough, if we look at global bonds or government bonds and look at the percent of bonds out there that have yields of less than 1%, effectively something more than 60% of all world bonds are trading below 1%. Again, our 10-year yield is 1.7. If you look at bonds that are trading with yields below zero, negative rates, 30% of government bonds, and that's mostly Europe, is trading at a negative yield. So our bonds at 1.5, 1.7, or 2.2 look fairly attractive. Let's talk about some opportunities. Investment grade bonds look somewhat attractive. If you look at the yield to worst, which is yield to call or yield to worst return, they're actually trading a little bit above the historic average. That's a big plus. Also, government or investment grade bonds tend to do a little bit better job in terms of providing negative correlation against the stock market. Read that as greater stock market protection. High yield bonds, which had been kind of the rage for the last couple of years, we think might be a little bit overpriced. And as you can see from that nearly flat line, they don't provide a tremendous amount of correlation. They don't provide a lot of protection. If the stock market goes down and the bonds you own are high yield, there's a good chance that they too will go down somewhat in value. Whereas investment grade will have a tendency to zig when the market zags. Municipals offer an interesting value. When you look at municipal bonds, because they're effectively tax-free, they more often than not will trade or be priced to yield something less than taxable bonds. And the thought is, when you add back the tax savings, your yield should be equal to that of a taxable bond. Today, if we look at the yield as it relates to munis versus U.S. Treasuries, whereas on average they would yield about 8% below Treasuries, today they're yielding about 4% above Treasuries, and that's a big move when you're talking about bonds. The other interesting thing is they're a bit healthier these days. If you look at the debt service as a percentage of state and local revenue, when you look at state and local municipals, it takes about 8% of their revenue to cover their debt. Compare that to U.S. Treasuries, which are 30% or more of revenue covers interest debt. It's pretty significant. Corporate profits here in the States are expected to rebound now after the big drop last year. That big drop last year was almost entirely the oil sector. Oil or energy represents about 13% of the S&P, and that drop caused earnings to drop as well. So as the S&P was somewhat continuing to see increases in earnings, kind of going all the way back to the recession, this was the big drop. Everybody thought maybe this is the beginning of a recession. It really had to do with the events that were happening in the oil patch. That should start to improve. Notice also that we expect earnings from energy to start to pick up a bit, so they'll also be accretive. And many of the energy companies have also done a good job of dumbing down expectations. So there's a good chance that when they do report earnings, those earnings may in fact be better than expected. As I said, PEs are a bit above long-term average. That would not be a positive. It's not a big negative because of the yield spread. If that were to reverse with values as high as they are, that might be problematic, but we don't see that happening anytime real soon. Let's talk about the PEs and where there might very well be some value. This is interesting. Anything above the line might be considered somewhat expensive. Anything below the line might be considered somewhat cheap. We think we're in this slow growth period. We think the Fed will probably raise rates. Growth, we think, should do better than value. We think the international markets will probably outperform the U.S. over some time. And if you look at large cap growth or mid cap growth, quite a bit more value there. A lot of money over the last couple of months have been piling into mid cap value, large cap value, and I think most of that move was because of the improvement in oil, and I don't think that that will continue. International earnings are certainly expected to improve. This is the S&P. That's their earnings, and a little bit of a tail off here. If you look at where they're at, they're probably fully priced. We've seen the drop in earnings, but in terms of international securities, they're still trading at some value below historic means. And when you look at emerging markets, we're not only seeing a little bit of an uptick in earnings, but a deep valuation in terms of what the intrinsic worth is. And you can see that over here. U.S. is fully priced to maybe a little bit above. Foreign is trading right kind of where they need to be, although their earnings are growing at a faster pace, so PEs could actually expand. And here, you're seeing valuations that are really pretty cheap in terms of emerging markets. The other incredible thing is we've got a tremendous amount of liquidity out there. If we look at money supply, or the amount of cash sitting out in our economy as a percentage of nominal GDP, it's almost 70%. There's $11 trillion of cash sitting out there. Corporations afraid to invest because they're not sure what the administration will look like or what new set of regulations will come down the pipe. Investors who are worried that the next drop will be another big one. Generally, you don't see huge dislocations in value when you have this much cash sitting on the sidelines. And just to remind us, we have gone a long way. This road here, while it looks impressive and looks straight up, we see large drops of investment along the way. That's a 14% drop. That's a 19% drop. That's a 12 or 13% drop, followed by another 12 or 13% drop. Small drops in value we've got to ignore. We want to avoid big drops, which really impact portfolios and change standards of living and lifestyle. But it's the small drops and the ability to stay put or stay mostly invested gives us the staying power to enjoy returns down the road. If we look at the S&P, this graph will suggest that anything above the horizontal line is an up year, anything below is a down year with respect to the gray bars. Quite a few more up years than down. In fact, 27 out of 36. But it's the red dots underneath the bars that really talk about volatility. They reference the amount of drawdown or pullback or hiccup that occurred during that calendar year. And you can see there's very little correlation between a hiccup and the end result for that year. The market was up 13, we had a 12% hiccup at one point. The market was down 19, and we enjoyed a 27% return for the year for those who stuck it out. The average drawdown or pullback is over 15%. So it's important to have some guidance and patience with short-term volatility, but we need to make sure that we have some plan of action for bigger drops beyond that. This is another chart showing kind of the same thing with the degree of pullbacks that we've had while we've enjoyed this impressive 200% move from the very bottom. Also, we're probably going to see another recession in the next couple of years. While the average recession takes the stock market down 45%, if we X'd out the Great Recession, the dot-com bubble, the Great Recession, the original Fed tightening back in 1937, which essentially threw us into almost another echo depression, the average is much closer to 30 for a garden variety recession. So downside protection for big drops, very important. And in terms of the long-term scheme of things, we've been somewhat consolidating here for a very long period of time. While the market's up a bit, about 4% per year on average over the last 15, call that 50%. Most of the moves in the market after a large period of consolidation generally are much greater than what we've experienced so far. So make sure that we keep a long-term objective and profile. With that, I'd certainly be interested in entertaining any questions you might have. Feel free to email me. You can do that directly at my personal email, james.cruzan@raymondjames.com. Contact us by going to our website, kaydanwealthmanagement.com. And while I'm at it, if you know of anybody, friends, family, business associates, who might like to take a closer look at what we do, we would certainly love the opportunity. Last but not least, I want to make sure everybody sticks around and pays some attention to the next several pages of definitions, risks, and disclosures. These will define any and all of the indices that were discussed or appeared on any of the charts that we used in this production. with that in mind, have a wonderful afternoon and hopefully a nice warm summer for us all. Thank you very much.